featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities. If you have any questions about the share or bond market, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Joining me on the panel tonight is Adam Goldstein. Adam is with SPA. He's the chair of the New South Wales chapter of SPA. He's also with FIIG Goldstein and Peter Eshu. Peter is from Envas, soon to be at Envas. I think you start on Monday. Welcome. Have you had a good week? Are you been on holidays? Is that the thing you've done? You've one of those classic gardening leaves, have a week off, and
I had a week off, but I ended up working a fair bit. So
now let's be honest. What sort of work did the wife just say? Look, that needs painting, and gee, you could go out there and do a bit of work there, or was it work that you were doing in, non-revenue performance or revenue performance?
Well, at home I've got 2 young kids under 2, so that's my full-time job. My part-time job is in markets. I had the Your Money, Your Call on Thursday here today. And a lot of conversations on the phone during the week.
So just watching the Bulldogs and doing a bit of work.
Yeah, we aren't going too good, but hopefully the Blues can make up for it on Wednesday.
He's a big Bulldogs fan. He wore the scarf when they were in the grand final. I don't think he'll have the grand final scarf on this year. I think it's going to be a tough one. How's your week been?
Very, very, very busy.
Good.
I've just got back from a 2-day staff off-site retreat where we take our staff away for 2 days. Talk about business and updating and getting everyone on the same deck.
And in that world that you're in that moment, the advisor world, how is business? How's that going?
It's tough. It's tough everywhere, and we're front line, so we get to feel and see what's happening in the world of business and markets before most people do. So when our clients are hurting, we see the immediate impacts and results.
Now, what's the sense of why the clients are hurting in a macro sense? I mean, in a soundbite, really. I mean, the economies, all the data points in the economy point to it being quite a good, strong, positive economy, but clearly there's a shift in the sentiment, the way people are viewing the market. So why do you think that the people are viewing the markets as tough? What's the driver at the moment?
Well, I can only speak from my experience. Our business is largely SME focused, so we deal with a lot of small business owners, and they are experiencing a different thing to what the indicators will show coming out of the economic figures. When things like their customers are slow to pay or aren't paying at all and getting stretched out in their payment terms and getting crunched on their suppliers, their cash flow is really, really tight at the moment. And obviously it's industry specific. It becomes very hard.
Pete, does that play into the way you look at the equity market, taking that sort of anecdotal experience and saying, okay, if there's things that are tough in the cash flow, and clearly the market, I think it's sort of rallied today, then it's slipped, and everyone's, Bernanke's come out saying, don't worry, I'm putting my 401k into the bond market. Does that? How do you assess that in an equity sense? If somebody's saying that times are tough, where do you look for? What are the data points you look for to try and work out how that should play out in equities?
Well, it really comes down to your investment strategy. Somebody who's 64 going into retirement is very much income focused. It's very different to a 30-year-old that can really go out there and be aggressive in this type of market. And I think, once you have your strategy in place, and this is a really good time to set your strategy. A lot of people, I speak to a lot of people during the year, the most common question 99% of the time is, what do you think of the market? Where's the market going? And when you stand back and say, why do you care? What are you doing? What's this whole investment journey you're going about? They don't have a strategy because it sounds academic, it sounds boring. Most people aren't, the type of people that sit down and write a plan. But it's a very good time to set your strategy. And then when you have that strategy, I think investing becomes easier. Not easy, but I think it becomes easier.
You'd agree with that?
You're one of the first few equity analysts I've ever heard talk about investment strategy.
That's why it's just been employed. So they go and headhunt these guys. They're smart guys. There's not that many smart guys in the equity world. That's what you're trying to say.
No, I'm not saying that at all.
It's a bond show here, mate. You've got to say that occasionally.
Well, I sort of sit in the middle of you two guys, so if I need expertise in any particular area, I'll come and talk to you about the bonds and I'll come and talk to you about the equities. But very, very seldom do we get discussions about, let's focus on the strategy. That's my world, that's what we do. And that's key.
Tell me about the bond bubble. It's the great narrative, it's in the paper every day, there's a bond bubble. And I think when I assess the bond bubble, I think they're talking about the US Treasury market, but they just see bonds as being one generic thing, and that's probably an education thing. But are your clients talking about the bond bubble? I don't want to be in bonds, or is that just not even part of the world that people invest in?
Short answer, no. It's not a question that comes up in conversation, largely because most retail clients don't have a significant exposure to direct bonds.
Yeah.
They may have some managed fund exposure or maybe some exposure in their superannuation, but that's all managed by a fund manager and caught up in a unit price. You look at SMSF, less than 8% of SMSF money is invested into direct fixed income.
And when you compare to the rest of the world, it's more like 26%. You know, it sort of makes some sense that there's something out there that we aren't getting. But what about yourself, Peter? Bond bubbles, how's that played out in your business? A lot of people coming out. I mean, the data, the points themselves, if you talk to the big fund managers, they're not seeing any movement in their bond investors, except the retail space. It's not coming out, it's just not going in as quickly as it was. So if it was going in at $10 a week, it's now going in at 4 or 5 or whatever it might be, but they're not actually saying give me my money back, because they're basically buying Australian credit. But how does it play out in your business? Do you see a lot of guys saying, I'm worried about the bond bubble, therefore I want to buy equities, or is it not part of your conversation, it's just immediate?
No, it's part of the conversation. I think a lot of the clients that we speak to, a lot of people that we have conversations with, are not people that have been investing in bonds for a while. So it's something that's foreign. For those that are there, you know, they probably have a little bit more sophistication. They have somebody guiding their portfolio, or they have some advice. But even them, I think we don't necessarily have such a strong bond culture relative to equities. You know, everybody wants to talk about BHP, Rio Tinto, China, pick the next 10 bag of small cap, you know, Fortescue went from $1 to $10 or whatever it was. That's where 90% of the conversation is from the people I speak to. And I think it's really unfortunate because, you know, having a diversified portfolio, having good quality bonds, spending just as much time, you know, per allocation looking at bonds, corporate bonds, and we have this thing where, you know, everybody says, yeah, but I don't get the franking and everything else. And tax is important, but it should not be the only consideration when you're going out there. So I think it's a combination of those factors that distorts a genuine conversation which should take place.
The ANZ put out a new hybrid. They put out an 8-year hybrid that went out at 3.4, and this is becoming the market convention. It's a new issue where it's very equity-like. But the thing was, they say we'll do 750. They always do more. They did $1 billion. And when I looked at that, I thought, we didn't have any clients that were buying that because that's just not our space. It's not. We don't do much in the way of hybrids. In that we think there's better value in over the counter. But it's interesting, if you're thinking bond bubbles, the customers actually want these bonds. Hybrids go really well when they're the names that they're very familiar with, aren't they? Did any of your clients want to buy the ANZ?
I haven't fielded the calls specifically. That being said, we do have clients in hybrids, but the structure of hybrids before January this year has changed significantly.
Yeah.
Obviously with the Basel changes. That you might as well buy the equity these days, is my view. This bond converts in 2021 to the equity, the underlying stock.
They can call it earlier, but the idea is that the way Basel III works is that you want more. The regulators want more certainty. They want you to have more certainty. So in the event that ANZ's capital, so the liquid money that it has, gets below, I think it's 5%. Once it breaches 5%, they force ANZ to issue, instead of debt, all those debt holders now have to wear equity, which of course that's when equity is getting smashed. You know, the equity price on ANZ will be down $10. And
last time you want to convert,
have a couple of shares. But they say that gives you more certainty. It's true, but it's very hard to then price. What's the risk of that? What's the value of that? And at 340 for 8 years.
But what investors see is the headline 3.4% above the 90-day rate, fully franked, and they go, that's a 6.2% yield. Yeehaw, let's go grab one of those. Without actually understanding the structure and the mechanics of what the hybrid actually is. And there's nothing wrong with it, just as long as you understand what you're buying in the first instance.
The interesting thing is that Westpac's come out with another one. They've come out with a subordinated one. So if you look at a capital structure, at the bottom of it is the equity. One up is the hybrid, so you've got maybe equity. Then you go to the subordinated piece, and that's where Westpac is. And it will probably be about 2.3, 2.4. And the rumour in the street is that it's not going as sort of more robustly as they would have thought. It's just, I don't know, Peter, do you think people value that different capital structure at all?
No,
they just look at Westpac.
Yeah, because they look at the spread and they say ANZ's giving me this.
Yeah.
Westpac's giving me this. Hang on, it's a different ranking. It's a completely different risk-reward exposure. So, and that's a difficult conversation to have. You know, to sit there and explain the legalities. It is very legal. And when you start getting into that, people say, okay, and then the equity, I can go out and buy the equity for 6 or whatever it is, gross it up. Look, thanks, no thanks. You know, if I'm going to go down this road, I'd rather go for ANZ because it's giving me the higher margin. I don't think ANZ is going to collapse or anything else. I'm not too worried about the ranking.
Yeah, I don't think it's
just give me the spread.
I just want the spread. I just want to get 6%.
That's right.
6% is sort of the tipping point. If you can get 6% on anything, people are quite happy with that. That's sort of.
I think the risk always is that clients understand the risk they're buying with their equity. They're buying ANZ Ordinary. They understand there's some risk involved with that. They buy the ANZ Hybrid. They think they're getting a fixed income investment, but they're not.
No, it's close, but it's not that.
They need to understand that.
It's time for a break, but we'll be right back with plenty more, so we will see you soon. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Adam Goldstein from SPAR and Sparks Goldstein. I keep getting that right. Skeggs Goldstein. And Peter Eshu from Invast. Now let's talk about Invast. New organisation coming out of Tokyo, is that right?
Yeah, it's a Japanese-based broking firm. They've been around for a while. They're actually listed in Japan. They're coming into the Australian market as part of an overall strategy to expand across the Asia-Pacific region. And in Australia, they're also going down the direct equities road. They're traditionally an FX firm, so a lot of interesting products and direct equities combined with that all provides a portfolio quite different to what they do in Japan. But they're willing to try different types of business structures for the market.
How big an organisation is it?
I think the market capitalisation is in the order of $80 or $90 million Aussie. It's a firm that's growing really quickly. They've added about 40,000 clients in the past 18 months in Japan. So with the Japanese market recovering and with all the stimulus, a lot of the Japanese brokers have become re-engaged, and there's a lot of innovation in that market, and that's flowing through into Australia.
And have they gone to anywhere other? Is Australia the first place they've gone to?
Yeah, Sydney's the first office outside.
So why is that?
We have, at times we set ourselves short, I think, in Australia. We have a very good regulatory system. We're an open and transparent market. You can get things done. It's very hard to go into places like Indonesia, for example, and set up a business, particularly a financial services business. So they appreciate the positives in Australia. They've chosen Australia. And look, let's face it, the Australian market, even though the Australian stock market has been challenging, the fundamentals behind the Australian wealth management industry are still quite positive. That super pool continues to grow.
It's that golden super pool, isn't it?
So when you combine everything together, and we're a Western country and we're in Asia and everything else, I think it's stacked up for the founders and the board.
And have they done any? When we watch in the paper, there'll be advertising, I suppose, and all that sort of stuff. But have they got any partners here to make the pathway easier, to facilitate that? Yeah,
they've actually partnered up with a very large Australian broking firm. I'm not sure if I can announce it yet, but it's a household. Don't announce if you can't. It's a household name. There are some very firm business relationships with well-established Australian companies here, and they've recruited. Other than myself, there's a very experienced team of Australian based people. So there are, very good question. Yeah, it's not just a foreign shop that's showing up. They are partnering with a very large Australian firm.
And when you say they'll have lots of product, and this isn't meant just to be a spiel for you, but I'm curious about the idea of what product are you going to, here's Adam, he's going to be a potential client, and so you're going to offer him foreign exchange, and you're going to offer him, do you have a sense yet of what the products will be?
Yeah, look, I've had a brief idea. I've caught up with the new management team here, and they have a product called ST24, which is quite an innovative foreign exchange product, very different to the Forex platforms that are out there in the market at the moment. That's what's really been popular in Japan. It is about setting different trading strategies, risk parameters, and it's very similar to a managed portfolio of foreign exchange exposures. Then they have MetaTrader 4 and a few other platforms, and then the direct equities. So, with a lot like Australian government bonds, for example, are now tradable through the Australian Stock Exchange. So you can potentially put together a portfolio of global ETFs Australian government bonds, your bread and butter, BHP, Rio, your banks and Guard, and get some foreign exchange exposure all in the one shop, and I think that's very appealing.
Yeah, no, I couldn't agree more. I think the idea that having this holistic look is always very attractive to a lot of clients, so they're going to have the one-stop shop and look at what they're doing. So I get all that. It's a question of...
And they can go to FIIG for all the
fixed income. Come down to FIIG and we'll be able to help you out and put it into the pipeline. We have our first email for the day. It's a viewer email from Noel from Parramatta, and Noel writes, it looks like interest rates are staying low at present. What is the best strategy at the moment? I have $250,000 to invest and I'm 40 years old. If Noel walks in the door making that statement, I know that you'll need a little bit more information, but in terms of if we assuming that Noel's in good health and he's got a good job and he'll be staying in that job for a long time and he wants to put some money away, how would you split that up? What would you think?
So these types of questions are always fraught with danger.
And we'll put the disclaimer on that you know,
such little information.
Noel, please don't act on this. Go and get some advice, as you know you should.
So, like for example, I have no indication of timelines or how long the money's invested for. There's no reference to any objectives.
I'm guessing that he's saying that because he's 40 years of age, it could be away for a period of time. He's saying, I want to put some... I don't know, but I mean, this is the email that came into the office. I'm guessing that he's thinking that I'm 40, I've got some volatility I can absorb.
This is how I would approach it. Firstly, I would need to understand from Noel what his level of understanding, knowledge and experience is with investing. For starters. Because it's not what I think is good. It's what Noel's happy to sleep at night and be comfortable and understanding what
he could take some of the foreign exchange products that Pete's got and he's might be not so sleepy if he's up all night worried.
That's a big piece here. Like, there's no point putting clients in things they just don't understand and they're uncomfortable and they can't sleep at night. It doesn't make any sense.
He seems to be worried though about interest rates staying low. So what would you say, Pete? Would you then go, let's just buy some banks, or how do you feel that if somebody's got it's clearly a chase for yield?
He said strategy. So if you go back to the strategy, which is what he said, what's the best strategy? My first reaction to him would be, if you've got a mortgage, my first piece of advice would be pay down your non-deductible debt. If he's paying 6% on his mortgage, by paying that off or reducing as much as he can, he's like earning 6%. Now
plus the interest.
And that's after tax. So if you can find me an investment today which is guaranteed to give you a 6% return,
6 plus,
and have no risk, you jump at it. So that would be my first piece of advice.
Parramatta and pay it off. What about you, Pete? What would you say?
Based on the assumption that Noel's saying interest rates are low, so this is probably an amount of money that's maturing from a term deposit or from cash, and he's looking at investing it. He's saying, I'm 40, so let's make the assumption that he has 20 years until he gets to the point. So, most people will talk about, you have to have some banks, some resources. We'll go down just giving you a bunch of equities you should buy. I think, the most important thing is to realise that at the moment there is a lot more choice as to what type of exposure you put into your portfolio. And what I'd encourage you to do is, on top of all the equity discussion, go and have a look at the ETFs, for example. Get a little bit of exposure in the US market, into the Japanese market. You can do that very efficiently now and cheaply. And add in your Aussie equities, add in some income type of security, because if the market goes pear-shaped, at least you have a certain proportion of your portfolio that sits there and it's going to generate the income. And I think just become a little bit more sophisticated around the allocation of your funds, because you can, and it doesn't cost you much now. It's very cost effective to go out and spread that out. And 250 grand, if you get that right, over the next 10 years, that could be 500 grand sitting there.
And it's the real key to it. It's all about the education. It's all about learning.
That's right.
We have to go to another short break, but please feel free to give us a call on 1300 30 34 35 for any question on investing. And the email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. My name is Mark Todd from FIIG Securities, and I'm joined tonight by Peter Eshu and Adam Goldstein, and they're here to answer any of your questions on 1300 30 34 35 and the email yourmoney@skynews.com.au. We were talking, we've got that email from Noel about the interest rates being low. Where they haven't been low, gentlemen, has been in US Treasuries, where they've gone from 2% 2 to 4% in the 30 years. Clearly, Bernanke wants to keep those interest rates low, and he's tried this week, and he's probably succeeding in doing that. But in the event he's not successful, there's a real squeeze on bank funding. And I'm wondering whether, as an equity guy, you're sort of aware of it, concerned about it. The idea that all the banks borrow so much money from overseas, and the way this process happens is they look at where treasuries are, they look where the rate of free cash is. That's the treasury. That's where they'll always get the money back. The government prints it, and they say, well, you need to deal at 2% over that. Let's say it was at 4. That's at 6. That means serious pressure on our mortgage market, serious pressure on our margins for the banks, but the mortgage market here in Australia starts to go up. Is the equity world worried about that at the moment? Are they
To be honest, I'm more worried about the other side of the ledger, the pricing on the mortgage book for the Aussie banks. About 60% of their funding is retail, which is not completely immune from what's happening in the United States,
Sure.
but is slightly more. And then you have 10% of their own equity, and you have about 30% which is exposed to that. And if you do have a sudden increase, then sure, that eats into your funding. But I think the biggest risk for the Australian banks is a price war on mortgages. Everybody's sitting there saying, "Oh, look, we're happy with growing at 3 or 4%, and our margins are comfortable." But it only takes one significant player to go out and say, "You know what, we're not happy with 3 or 4%. We want 10%. We're going to cut our pricing," and then the rest of the industry will move. I think for me that might be completely blown out of proportion, but that's what I'm really worried about for the Aussie banks. And then I think second worry is the elevation in that 30% of funding, the blowout, and what that means for your pricing. You could have a double whammy when both occur. Because when you're talking about 220 basis points net interest margin for a bank, and they have 8% of their own equity in there, it's a return on equity of about 20-25%. I just think over the cycle that's unsustainable.
Yeah. What about you? In terms of you're putting your clients into the banks, and do you have any concerns about not so much the profitability, but the pressure that they will be under? Credit growth. You've just said it's people are doing it tough. That puts pressure on credit itself, so there's more failures around people paying their debts. That's harder on the banks. Is that something that is of some concern?
Well, absolutely. We need our banks to be profitable, there's no doubt about that. But if you ask the consumer in the street, are they worried about bank profitability? Probably not.
No, it hasn't happened yet.
Probably not the right question to ask them. I must admit, though, we have, for a first time in a long time, getting clients at fixed rates in today. At least half of their mortgages we're fixing in.
Oh, really? They see themselves at the bottom of the cycle?
Well, who knows? You never know these things until it actually happens. Who's going to win Ashes in the next couple of days?
Australia.
We're going to go and get a whole bunch of 18-year-olds and have a whack.
You just don't know, but if you can lock half your way, the rate's pretty good at the moment. It might go a bit low, it might not, but if you lock half of that away and see what happens in the next rate move, if it goes again, lock the whole lot away, I'd imagine it's pretty cheap money right now for lenders.
What is the borrowing rate now? Like, what sort of numbers have they put in? Is it 3 years, 5 years? What sort of fixed term?
We did one today for a client with a it was about $1.5 million, and we locked in 459 for 3 years.
459
for 3 years. So
wow,
it's gold. It's a good time to be doing this, having those discussions.
Seriously, if you've got a job and you're getting cash at under 5%, you could borrow the money fixed and go and buy the banks at 7%, and CBA gets sold off, buy the banks at 7%, and you're making money on your own. Borrow it from CBA, go buy their equity, and you probably do all right.
So now's the time to be having those discussions with your banks right now.
Yeah, get in there and start talking about your fixed rate returns. What are your expectations for the cash rates? What do you think cash rate 2030? This year, what do you think will happen?
I think we're close to the bottom, 2.5%. I think is where sort of the RBA will sit back and say, you know what, we've moved a fair bit, we're probably going to wait and see. I think every time you start seeing the front page of the paper talking about interest rates going to 1 or 0, that's a sign. When everybody,
that ain't going there.
When they were going up, everyone was fixing at 9%, saying, oh, they're going to go back to 15, 16%. You can now borrow 3-year at, call it 4.6. Everybody's talking about, oh no, rates are going to keep on falling, and what if they keep falling? I think you just need to be slightly contrarian. And if you're going out and buying an investment, keep in mind, if you're borrowing at 4.6 and you're going out and buying an investment property that's yielding you 5%, or bank equity that's yielding you 6%, Doesn't matter if rates continue to fall. You've locked in that spread. So be it, you know. And you don't actually want rates to fall too much because it means that the state of the economy is so bad that the central bank is panicking.
That's right. That's the next question. You know, that we've got the cash rates going down, and let's say they go to 2.5. We have the IMF downgrading expectations, saying that we think the economy is, you know, in trouble globally. They downgraded even the United States economy, but equity markets continue to rally. It's a conundrum for me. I'm struggling to come to grips with why. I think of GDP as the client. I think of it as the consumer. And if the GDP is getting smaller, the consumer's eating less. There's less money being spent by the consumer. And then the equities rally, so there's pressure on margins, but they continue to rally. You know, I'm sort of at a little bit of a loss to understand why that's happening.
There's a big mismatch between the nature of the Australian economy and the composition of the Australian market.
Yep.
You know, and when you see the ASX 200 index and we say, oh, the market's going up, 12% of that conversation is BHP. And BHP has, you know, they have Australian assets, but their contribution to the Australian economy or employment is very, very different to the situation on the street. And if you take, you know, your Woolies, your retailers, they are so fractionally insignificant. Even Woolworths is fractionally insignificant to the ASX 200 index. So we're very lucky that we have a very sound financial system, and the banks, which are about 25% of the market, have performed well. But you know, the ASX 200 index tells you nothing about the Australian economy.
But isn't it interesting? I don't disagree. I'm not the equities guy, but isn't it interesting because if the banks make up such a large percentage, 25% of that ASX 200, they're the ones that suffer the most from a downturn in the economy.
Yeah.
People, you know, their credit is weaker, so I can't lend you as much. They don't want to pay back their debts because they're going to, you know, they're not doing as well, so they can't afford to pay off debts. And then everyone gets more conservative, so they don't consume more, so they don't borrow on their credit card. So you'd think that big component would suffer the most, and they haven't really suffered.
I think what's happened during this downturn is that the commitments to the banks have fared much better than consumer behaviour elsewhere. So people are meeting their obligations to the banks in a very different way that they're meeting obligations to counter businesses, to their employees, to going out and spending and expanding. And so I don't know whether that's sustainable. I don't know whether that's a structural shift, or the banks have fluked it, or it's about to turn.
Because your consumer is getting so much more conservative, they pay off all their debts earlier. Like house ownership has been phenomenal. We have to go to another short break, but please feel free to call us on 1300 30 34 35 for any questions you might have on investing, and the email is yourmoney@skynews.com.au, and we'll be right back. Welcome back to the show. If you have any questions about the bond or equity market, please pick up the phone and give us a call. 1300 30 34 35, and the email is yourmoney@skynews.com.au. And we have our second email for the night. It's from Ian from Melbourne, and Ian writes, what sort of returns can I get on annuities? I've been investing in term deposits, but the returns have been regularly coming down because the banks don't want the money. What can I get? I suppose I'll start with you because in the ad I asked you. So what can you get?
Well, we looked at some annuities that are available today, and 1 year rate's about 325.
Yep.
And the 5 year rate 405. So that's a 5 year fixed term annuity where you get your capital back at 5 years.
Who's providing you with that?
That was with Com.
So isn't it interesting? You've got people fixing their mortgage at just 5%, 4.5%. You've got people lending, you know, the bank's borrowing money at 405. Yep. Boys, there's trouble in paradise. That doesn't work.
The maths doesn't work, does it?
The maths are quite wrong on that. So that's interesting. So I'm guessing that you don't borrow the annuity at 405, but you do borrow fixed at, you know, 450, and say I'll borrow the money rather than get that return. We looked at we do a lot of annuities at FIIG, and we do the annuities that Challenger does a great job in annuities. It's a great marketing, and everyone likes that consistency of earnings. But you can get indexed annuities. So indexed annuities are linked to inflation-linked annuities, and I'm a big believer in getting protection.
So the capital value increases with
That's right.
CPI,
so the income stream moves up with inflation. Inflation, let's say it's 2.5. I think it's probably going to go higher, and that will get you somewhere between a 5.75% to a 6% return if inflation's 2.5. If inflation's higher, you get a higher return. I quite like that. I like having annuities based around. They're annuity bonds. They're not actual annuities. And Challenger's different. The thing about Challenger is that it's a life insurance company. It's a different regulatory world. When you give them money, there's greater certainty around. It's much safer compared to, say, the CBA, because they're an insurance company. They have different environments. I used to work in the insurance business, and it's very complex around being compliant, because the last thing a regulator wants is if you have a life insurance policy and I can't pay it out. That's the complete disaster, because they get such crappy.
But like, for example, how much risk emphasis would you place on comparing, say, a Challenger life annuity compared to a Praeco bond, which is one company essentially?
Yeah, well, the Praeco bond is the Defence Housing Building, so we're taking the government income stream, and I quite like that one. I can sell that one. That's something that's some comfort, and there's no refinance risk, there's none of that, and it's the Defence Housing Building. I always say they won't make it a backpack. It's got a specific role. It will be that role.
I think too we should just on annuities for 1 second.
Sure.
Is we should also have a discussion about the dual purpose of annuities, and one is to obviously provide a level of fixed income return. The other is to address longevity risk. So the rates I gave you were for fixed term periods of time. You can also ring an insurance company or an annuity provider and actually get a quote from them on designing your annuity to suit your circumstances. Varying lengths, varying residual capital values on death or reversion to a spouse, and even indexation of income. So we speak a lot about matching assets to liabilities, and this is a great example of putting in place something to do that.
Yeah, I do want to talk to you about that, because I think that the problem with that strategy, and that's all fine, but the problem with that strategy, Pete, when you go to do that insurance, when you go and do that annuity, they're going to look at you, you're a young bloke, they're going to say, now hang on, when will I have to stop making the payments? And you say, well, I want you to stop making the payments when they put me in the box, when I leave this mortal coil. They say, now that's very complex. I don't really know, so I need you to do some health analysis. And when you become right six stock standard, when you're right in the middle of it, that now becomes an 80-year maturity, or an 85 or 90. And now we're thinking, hang on, that's 50 years. So the interest rate you get is probably 1%. You get a very poor return. But I definitely agree, when you retire as a 65-year-old, there's probably some roles to play in annuities that plays that way.
And even put all your money in there, but if you're good to have an income stream that lasts the day you're going to die, and you can be certain about that.
Absolutely.
That's addressing another level of risk, which is obviously too long.
I do feel that you should be matching some of those assets with those liabilities. We can talk about that in a minute. What's your thoughts on inflation? Do you have any worries about it?
Yeah, I do. I think you need to be. I think there's inflation in the real world, and then there's CPI.
Yep.
And I think you just need to be mindful that CPI is a measure that is official. The most official statistical body in Australia releases it, but it's not reflective of everything else that happens in the real world. And I think you just need to keep that in mind. It's good to have inflation hedging, but have a little bit of real inflation hedging too. And this is where my stock hat comes back in.
Put it on.
At the end of the day, equities are out there in the real world. They have more volatility, they're riskier, but they're also leveraged to, flows within the real economy, and that should flow through into your dividends. And also, I guess, property. Direct property. You go out and you buy an investment property if you think that inflation is here for the next 10 or 20 years because of, all the money printing that's been going on in the US and Europe and now in Japan. Then just be mindful that, as paper becomes less valuable, real assets become more valuable. It's difficult because you can mistime that in the short term.
Timing's a killer.
And you could be really wrong and you can blow 30 or 40% of your portfolio. But just keep that in mind.
Last week we had some guests on, they were discussing that, and I think one of the things that we were very conscious of is the effect of when the currency goes down to 90s and into the 85s, whatever it might do, you import inflation. So you buy the flat screen, you buy the things that come from overseas.
The fuel.
And one of the guests saying, look, you go to the Bowser right now this week and you'll find that it's more expensive and it hurts. The idea that the retailer will bear the cost of that is impossible. He's got to pass that cost through to you, and that's where the real inflation hits. And I think, as they were saying, if the retailer doesn't pass that cost on, then that equity gets hurt, because Wesfarmers, Coles, Woolies, all these sort of JB Hi-Fi, if they can't pass those costs through, Harvey Norman, then their margins are so tight you're going to have to see them come down anyway. So that's really interesting if you're thinking about and I'm putting my equity hat on, if I'm thinking about the retail, we often think when it's tough, we go into those retail sectors that are constantly being used, but in reality, they might actually be the worst place to go in tough times because they're going to be subject to some inflation headwinds.
Yeah, but look, I'll tell you what, take apparel, for example, right? When the currency goes up, in theory, it should be good for the retailer because they're buying product cheaper, but everybody else is buying product cheaper and they're dumping in the market and the price point goes down and your margin disappears because, it's so fragmented. When the currency goes down, the fragmented guys can't hedge. The big retailers can hedge, so they protect their price points. So it is so difficult and industry specific that I think that there are so many different variables. I think what you're seeing in consumer electronics is suppliers now aren't reducing their price points, they're just changing their products. New specs, trying to keep the average price point of an LCD or a plasma TV at $1,000 or $1,500 as opposed to going down to $200 or $300. So they have to pass it on, but they'll pass it on with a few bells and whistles.
It sounds very complex, so I'm going to take my equity hat off. We have to go to another short break, but please give us a call on 1300 30 34 35. For any questions you have on investing, the email yourmoney@skynews.com.au, and we'll be right back. Yep. Welcome back to Bonds versus Equities, Your Money, Your Call. We're here tonight taking any phone calls you may want to use. 1300 30 34 35 or the email yourmoney@skynews.com.au. And I'm guessing everyone might be watching some sport, so there must be some sort of AFL game on. I mean, I can't tape it. What does a balanced portfolio look like now for a 60-year-old? What would you anticipate? And we'll start with you because you'll see more of them, and you probably know a few 60-year-olds. What would happen? He comes in and says, I want a balanced portfolio. I get it, but you have to put your rubber hits the road. You have to give me a balanced portfolio. What would that be?
The difficulty with balanced portfolios is we're talking about the ratio between growth assets and defensive assets. Yep. That's what we're talking about. But there are growth assets that are more secure than some defensive assets.
Yep.
For example, having money in CBA share is not as big a risk as, say, having some debentures sitting out there on a property development, which is fixed income and defensive in nature.
Yeah, right.
So we need to get down to, I always get back to the knowledge and understanding of the client again, and that is where you're at with this, what do you understand, and balance has always been a 60-40 ratio for me, but I'm tending to be more 45-55 now.
Yeah, I suppose that's where I'm trying to come to, because I went to a conference, I gave a speech, and it was a planning group, and all their clients, and they came out and they said, well, we want a balanced portfolio which is 70-30. I said, well, what is that of? And they said, well, 30 cash and 70 equities. I said, but that surely can't be what balance is nowadays. Surely that can't be that. What am I doing?
But what's the logic and science behind that?
I get it. And I'm trying to understand whether it's just about education that you've just said, look, I was 60-40, I'm now thinking 55-45. I mean, what do you, if somebody comes and says, look, can you construct a portfolio? I want to understand what's your interpretation of balance. If somebody says it, because to everyone it could be slightly different. And I understand it's coming from the client. But if I walked in, a young man myself walked in and said, "Look, I want balance," what would you? How would you offer? How do you go about working that out?
Play golf and get a job.
Well, it depends what you mean by balance. Some people interpret medium risk as balanced. So they think balanced is the right word for a moderate level of risk, right? So that could be 90% in cash, 10% in ultra high risk, where if you blow up all your money, you still have 90% in cash, and if you do really well, 90% of your funds are protected, but you have huge upside from that 10%. It could mean going out and really diversifying if you have $10 million or so. So, it all depends on what you mean by balanced. Balanced in terms of income, in terms of risk, in terms of upside.
But the clients don't know that. See. I had coffee with a customer today, and he was complaining about a stockbroking firm that's well known. And he said, I wanted a balanced portfolio, and I've lost all this money, and I'm not happy.
I'll tell you why. Because because they've gone and invested in what they perceive to be medium risk businesses.
Yep.
And guess what? There's no such thing as medium risk.
Yeah.
You either have risk or no risk, right? So you have to say everything is in a risk basket, and I'm going to moderate that by adding no risk, and I'm going to find the instrument that best resembles. So people go out there and they say, okay, Leighton's, for example, medium risk, one of the biggest construction businesses, blah, 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 sounds really good. Guess what? Leighton's halves in the course of 2 or 3 years. Newcrest, gold is going up. It's one of the largest gold producers. It's at a quarter of where it was, because we don't have a good ability for defining what's low, medium, or high risk. And so it comes back to what is your primary, or what do you want? You want to spread out so much that no single exposure can blow up, or do you want a diversified income stream? Is that what you mean by balanced? Or
okay, so if the fastest growing sector is the self-managed super fund sector, and by default they're not fund managers, and by default they probably don't know what they want.
Yeah,
that's the problem. Like, if they come in and say, I just want to get my money back and I want 6%, I don't know what you say. I mean, how do you respond? Like, what are the customers asking, I suppose, is more my question.
Well, for us, it's purely an education process. When I hear the word balance, what rings to me is diversifying.
Yep.
And I don't know that you can go to a stockbroker, for example, and get a balanced portfolio, because it's all going to be equity based. You might have some fixed income in there and some property in there, but it's all still equity based.
Yep.
And you have this huge component of equity risk. So diversification for me is having some exposure to assets that don't have equity risk, like a direct property portfolio or direct fixed income, having some exposure to Australian shares that give you this equity component that you need, and diversifying your portfolio across asset classes as well as different structures.
there was actually a survey that came out a couple of months ago that showed that those that are in industry funds or retail super funds, have smaller balances. I think the average balance is $40,000 or $50,000. SMSF about 500,000. But those in the retail or industry funds have more sophistication in the way that their portfolio is composed than those who go out to invest their own money but don't put that sophistication together. And I think you go through a learning process. We're all in it, but you're right. You need to spread out your equities. You need to spread out your fixed income, your international opportunities, and you're not going to know at the beginning. But you need to continuously ask yourself, what am I trying to achieve?
Because that's a really good point, because when you think about it, the industry super funds go out of their way to make sure all their investors are completely aware of what they're doing. This is my growth fund, this is what I'm putting my money in, this is my defensive fund, this is what I'm putting my money in. You tick the box. And then they give you reams and reams of information, whereas self-managed super funds tend to buy more coffee. They're going to have a cup of coffee with a friend and work out, what am I going to buy? And they keep the coffee shops going.
Well, I suppose the statistics tell that story. Less than 8% of SMSF money is in direct fixed income.
Yeah, crazy.
I think it's less than 15% is in international equities. So you look what's happened at the moment in the last 8 months with the markets.
International equities.
If you're not exposed to the US, you've missed out on a massive exposure in your performance.
Japan.
It's right. It's one of our largest trading partners.
Yeah.
It's right there, the world's third largest economy, going through
Structures.
revolutionary stimulus.
Yeah.
Yet how many Australians have exposure to it?
And the topic's up 45% or something.
And we're going to go to a break in a second, but it's one of the troubles is trying to get exposure to it from what you've just said, because you don't know enough about it, and then you just throw your money in it, platinum, and say, I really hope they work well.
My story to my clients is diversification is like a car engine. You've got to have all cylinders firing at different times, and that reduces your volatility and takes your risk out.
Yeah, perfect. Okay, it's time for a short break, and we'll be right back in just a moment for our last session of the night. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me today we have Peter Eshu from Invast, soon to start on Monday, and we have Adam Goldstein. Adam is from FIIG Goldstein and is the chair of the New South Wales chapter of SPA. And I didn't ask you about that. Can you tell me about SPA again?
I certainly can.
I'll tell the viewers. I know what it is, but I mean, it's obviously we were talking about the idea of education. So SPA, that's their job. That's the thing that they're front and foremost, isn't it?
Yeah. So FIIG Goldstein is a wealth and accounting firm, and we specialise in self-managed super funds. We have been doing since 1989. 10 years ago, a group of advisors, accountants, financial planners and lawyers got together and established an association called the Self-Managed Super Fund Professional Association of Australia, with its sole intent to increase education, knowledge for SMSF advisors in this space across all different professions. So since that time, we've now got nearly 3,000 members. We have a very in-depth and specific education program around specialisation, so specialist advisors and specialist auditors. The auditor piece has been adopted by legislation, which has been a great win. The exams are set about master's level, so it's
New South Wales legislation or federal?
Federal.
Oh, right, okay.
For auditing.
Yep, right.
So very involved, very engaged. They've had a lot of work to do with regards to shaping, communicating legislation.
Do you hold conferences and can the viewers, sign up and join a conference and you can talk to them about the latest evolution? Is that something that it does, or do they look on websites? How do they access the education that you're providing?
Yeah, it's not designed for trustees. It's designed for professionals in the industry.
Right.
Who then use that education to pass on their advice
to their clients.
Correct. Yeah.
So it's the market. It's sort of only to the professionals. But if the person who is using the professional says, "Have you got the latest information from SPA?" They could say, "Well, what's SPA?" And you could,
SSA is the Specialist Advisor designation.
Yeah.
SSAUD is a Specialist Auditor designation. So. Consumers or trustees in the marketplace should be looking for these designations because they're the best in the industry.
Yeah, right. Pete, what's your worries about the market? What are you worried about?
It's very hard to be disciplined in this type of market, and so you get excited about the market and it goes up and then it comes back down and it's just this wave pattern. And so I think you need to be really disciplined and just understand that it's a very difficult investment market. A lot of parts of the economy now are very difficult in terms of business. If you're in the carpentry space, or if you're in retail, or if you're in whatever it is, I talk to a lot of people from different professions, and I ask the question, is business difficult? Yes. Is it more difficult than what it was 10 years ago? Absolutely. So too is investments. So this investment journey is difficult, and you just need to understand that. Be patient, don't get too emotionally caught up, and always have your horizons open for new opportunities.
What about you, mate? What are you worried about?
My number one biggest concern at the moment is the new euphoric wave of SMSF property investment. Can
you tell me who's spruiking that? Is there people that are? Let's not get into any sort of litigation, but are people promoting that?
Yeah, absolutely. There's been programs on ABC and Channel 9, the like, who have named these people.
There'll be a program on Foxtel,
But these companies are making 25,000 cold calls a week.
25,000 calls?
Cold calls a week, calling people and talking to them about investing in their SMSF money into property. They attend seminar, and before they know it, we're getting phone calls. It has become so robust what's happening in this space at the moment. It's quite scary.
Whose child of what parent would be making those phone calls? I mean, that seems strange. My job is to cold call people, and spruiking, clearly a somewhat spurious product.
You can't prevent these things from happening.
Are you worried that on the actual investment property purchases, or that trustees are blowing money to these people?
Potentially, this could be the next big blow up, without a doubt. So my 4 pieces of advice on this are, if you are approached by these people and you're thinking about doing this thing, that's fine, but let's get some independent advice first and just do a double check. If the investment is as good as they say, it will stand the scrutiny anyway. Number one.
How do you check it? What do you do?
They provide you with significant glossy brochures and
beautiful pictures always. So
a good place to start will be to get independent valuation of the property you're buying, as opposed to getting valuation from the developer.
Doesn't the bank? Won't the bank filter out if there's borrowing on it? I guess where the risk is where you're not borrowing, and until the bank comes in and says this isn't worth what you say. But then that comes down to the accountant that's doing the audit for the SMSF, right?
Yeah,
to
absolutely.
Say, look, this is.
We'll talk about that in a second, because we actually are. Hang on. We're going to go to a break now. We'll be right back after the break. We'll be right back up for our last session of the night, and we'll be taking a break. But before, I've now been told we've got 1 minute on program. One last question.
Yeah.
What's the low-hanging fruit?
I think the small cap space is starting to
How do you find out about what
you have to research, right?
Yeah.
It's very hard. don't be lazy when you're investing in small caps. Even if it means you find one opportunity a year, know it really well, and if it doesn't stack up, that's okay. Businesses that I like, Vocus, NextDC, Xero, for example, while the rest of the market's been going nowhere.
You're not going to get to give an answer. I've only got 30 seconds.
Okay.
We have to say goodbye.
Low-hanging fruit is the small caps, particularly in the technology space.
Thank you very much for coming on the show. That's all
My
we're going to
pleasure.
have for tonight. Thank you for Adam Goldstein from SPA and Skeggs Goldstein, and thank Peter Eshu from Invast. Enjoy your weekend. It's over to you. Thank you for both of the emails. I'm Mark Todd, FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.